All right, good morning again, folks. It's Hari Swaminathan. Thursday morning, 9:51. The markets have opened, and as expected, Tesla has gone up nicely. We made one adjustment. We closed out the 100 puts and opened the 130. I think I've already sent out an email on that. And what I wanted to actually take a look at is Green Mountain because this is really a phenomenon that's happening, and I think it's going to be very educational. So we need to look at this Green Mountain, what happened with this position properly. Now, yesterday we put a straddle in the October series, and you can see Green Mountain is down. It's not down by a whole lot, but you see the puts have lost $3,000, and I'm sorry, the calls have lost $3,000, which is to be expected because the stock went down, and the puts have lost 275. Now, how is that? If the stock goes down, you would expect your puts to gain in value, but it has not. So, which tells you that this is an example of a volatility crush in play. And so now the very reason we went out to October was because we thought that we would not face this volatility crush. So let's just explain what the volatility crush is. Let's go take a look at the Green Mountain options and look at the volatility. Now, if you remember, yesterday this was in the hundreds and it came down, 80, 70. And when we reached up to October, it was at 61, if I'm not mistaken. And we said, and even the ones after that were all 60 and, all of that. So we said, okay, October is the steady state. It should be around 60. But what ended up, as we can see today, everything is in the 50s. So obviously the 60s was not the steady state, and in fact the 50s are the steady state. So the volatility has dropped from 61 to 52. That's almost 10 points on this October series. So now this is quite a rare occasion. Usually you will not see volatility crush in these back months at all because the back months really are not affected by the earnings event, and that's why we assumed that these months are safe from a volatility crash, but it wasn't. And as it happens, all of these months had been bumped up by about 5 to 8 points in volatility, and October in particular had been bumped up to 61, which is now 52 today. So the vol crush was 9 points right there. And so if you look at the position, and if you look at Green Mountain Coffee, you can see this. You can see the Vega value is 268 right now. And so, of course, it would have been a little different yesterday, but let's say it was 300 and 9 points at 300, positive Vega and a 9 point crush is a $2,700 loss right there. And this is why you're seeing this loss. So, of course, we have plenty of time, so I'm not particularly concerned about the position. But I think what is the big learning factor here is this volatility crush. You're seeing it right here, even though the price is going down, but even the puts are losing value. How is that possible? That's because the puts are actually gaining value because of the price movement downwards. However, because of the Vega crash, it is losing value. So, if you wanted to actually look at what that would be, we'd have to come to the options, and in the option screen, we have a Vega value right here. So if we look at our Vega is right here. So we lost 14 points of Vega for every 1% drop, and we know it dropped 9%. So which means $1.26 went out of this option value just because of the Vega drop. So this is definitely what the volatility crash is. So if anybody has not experienced it before, this is what it looks like. It's not a big deal. I just wanted to explain this phenomenon because it's a very important one. We took care to go out to October to make sure that this doesn't happen. But what we did not realize, obviously, and it's very hard to realize that, is that all the series, even past October, had seen a bump up in volatility. So regardless, we have plenty of time. We can manage this position. Let's see how Green Mountain goes. But for now, what we want to do is just look at it, and the Tesla is working out. So I guess it was one up and one down. But what we need to do now is to manage this, manage the Green Mountain position. I also wanted to quickly look at the Herbalife. As you can see, now we have a 65 and 70. I want to actually put it up on the, because Herbalife is starting to do well, and this is what you would expect to see with Herbalife. So let's go take a look at a Herbalife risk profile, and I think it'll become clearer right there. So we have a 65 put and a 70 call, and both are short. And now you can see Herbalife is coming right there. You can, this white line is going to, start going in there. Our break evens are quite far away at 79 and 55. So we are okay on this position, and we would have to nurse this position into a profit. So when a position goes against you, this is what we have to do. And of course, this was an earnings play, and so is the Green Mountain is an earnings play. So when an earnings play goes crazy, then we have to sit and basically take care of it and make sure it comes back into the profit. Now, Herbalife, when we did the adjustment yesterday, we did take I mean, it's not a loss because it's coming back here, but by closing that 65 call position and opening a 70 call, we have booked a loss. However, that loss is recovered by the 70 call. So basically, here it shows the max profit is 9,500, but it actually won't be. Our max profit on this position will be only about 6,500 or 7,000 if this thing expires right here. So basically, we'll have to, I think it was $2,500 that we took a hit on. So we'd have to subtract $2,500 from this max profit zone. All right, so that's it for this morning. We've got enough positions, so I don't want to open anything new except for the price line. I want to see what price line is doing, and please look at the strike prices before you put price line on. Thanks.